Shri Venkateshwaran Ramakrishnan ji. We welcome you, sir.
Namaskar.
Namaskar, sir. So, sir is presently Deputy General Manager at the Financial Sector Economics Analysis Cell at Securities and Exchange Board of India. He is Masters in Public Administration with specialization in Economy Policy Management from Columbia University in the city of New York. He is one of the program ambassadors in South Asia. He is the fellow member of Institute of Cost Accountants of India and a Masters in Economics and a postgraduate diploma holder in Securities Law. He has undergone in-person training programs at Asian Development Bank, US Securities, IMF institutes at India and Singapore, Chicago University, Booth School of Business, and the World Bank. So I welcome you, sir, and over to you for taking your session on enhancing role of capital market to achieve the 5 trillion economy target. Over to you, sir.
Thank you, Shalini. Dear Sri Nihar Niranjan, dear Sri Tarun, distinguished members of the ICAI and other dignitaries, a very good evening to all of you. Today, the nation is celebrating the Azadi ka Amrit Mahotsav, the 75th year of our independence. At the outset, I pay rich tributes to the founding fathers for having bestowed us a free nation with all its virtues and opportunities. Their sacrifices remained us task. We have our duty towards taking this nation to the greater heights in the coming decades. I compliment the Committee on Economic, Commercial Laws and Economic Advisory of the ICAI for having chosen such a topical theme for the Azadi ka Amrit Mahotsav webinar, and thank you for giving me this opportunity. Before I dive into the topic, let me give the usual disclaimer. The views that I will be expressing during the course of this presentation are all mine, and it does not necessarily reflect those of my employer, the Securities and Exchange Board of India. Now, let me begin with a popular definition of democracy given by Abraham Lincoln. If democracy is of the people, by the people, and for the people, securities market is for the investors, by the investors, and for the investors. So without investors, securities market is void ab initio. So how is it that in a $5 trillion Indian economy, the investors and the securities market, or put broadly, the capital market, play a role? That is the topic of my today's talk to you. So now, I just want you to have some perspective of what is it that capital markets or the financial sector has achieved in the past. Where are we today when compared to what we were at the time of independence? So I just draw your attention to a few slides wherein I have done some analysis of the share of the financial sector in the overall economy, Indian economy. Now, when I say that one, everybody today present here are aware of the fact that there has been a revision of GDP figures, the methodology, with base effect, base year taken as 2011-12. So I have to draw on 2 data sets. One is it which will be not belonging to that particular 2011-12 series. So that will be the previous data set, and the new data set which will be having 2011-12 as the base year. So why am I doing it is because I will be able to show the growth, or okay, of course I have told you the secret, the rapid growth that the sector has achieved over these years. Now that's what actually, so to put it correctly, I have broken the series into 2. What is it that has been achieved as per the old series? I am putting as a separate chart, and another chart to give the present series with base year 2011-12. Of course, being chartered accountants, you don't need to be told or reminded that if the methodology changes, the results can also differ. So there are a few years which are common to both the series, So you will find that there will be a little bit of, there is even large difference as regards financial sector is concerned, as regards the share as well as the growth rates. But please kindly ignore that one, because new methodology means new sectors are being included. I will give you one example. In the case of manufacturing, in the new series, we are even including mobile manufacturing, which was not the case in the previous year. Previous data sets, which were, pre-2000 and all. So this methodology is what is leading to this difference. Kindly ignore that one. Now, coming to the findings. If you can look at the first slide, you can find that orange line, which is the growth of the banking and insurance subsector. Now, why am I calling it a subsector? You all know that there are basically three sectors: primary sector, which is the agriculture; secondary sector, which is the manufacturing; tertiary sector or the services sector. Now, in the tertiary sector or services sector, in the earlier series, there was a separate data point that captured the activity of this banking and insurance sector exclusively. So I am looking at banking and insurance sector data starting from 1950-51 and going on up to 2011-12 in this data. And the take home that I would like you to have is that the orange line depicting the banking and insurance subsector has been outperforming the growth of the GDP, which is depicted in the form of the blue bars. So this is for the previous year, previous series data. And now, as I told you, I have taken the new series data to see what is it that the present state of affairs is. Now, here, the Central Statistics Office has given the definition of financial services sector, services subsector. So they are not restricting themselves to banking and insurance. They are including securities market. They are including financial services at the macro level. So there you can find that, of course, when I look into the data from CSO, the latest data available of banking and financial services sector is of 2016-17 only. And as I told you, financial services sector is falling within financial, real estate, and professional services. So that is the bigger one, which contains real estate and professional services also, in addition to financial services. So here also you can find that except 2011-12, 2015-16, and 2016-17, even in the new series also, the growth rate of the financial services subsector has been better than the growth rate of the overall Indian economy. Now, I am sure all of you would have made that particular, conclusion in your mind. And what is it? If the financial services sector or the banking and insurance subsector is growing at a higher pace than the overall growth of the Indian economy, what will be the impact? Definitely, it is a case of the financial services sector or the banking and insurance sector increasing its share in the overall GDP. Now, that's what I am trying to present before you in the next two slides. So in the old series, because it is more than 50-year data that you are having before you, you are seeing such a steep rise. And how you should read at those numbers, it shows that in 1950-51, the banking and insurance subsector accounted for a meager 1% of the GDP. Today, the latest figure available as per that previous series, the latest data available is of 2012-13, and you are seeing that particular share of the banking and insurance sector shooting up to 9.4%. To put simply, banking and insurance sector accounted for 1/10 of the total GDP of the country. This is the remarkable growth that the country has achieved, the sector has achieved over the period since the independence. Now, let me take your attention quickly to the new series. What is it that it tells? As per the new series also, we are finding that there is an upward trend. But as I told you, there are many subsectors got included in the computation of GDP. like mobile manufacturing. I mean, you know it. I mean, there are so many equipment that we are using. So because of that, so like out of 100, our share has shrunk, but it is showing steady or rising one only. But the shrinking of the share is not a result of the absolute value coming down. It is always going up only. The portion of the GDP, or rather the GVA, that is accounted for by the banking, insurance, securities market, everything put together, which is the financial services sector. What you can see in that particular chart, the orange line, it shows that in 2004-5, that is the earliest data available as per the new series. And this is what I told you. There is a little bit of difference, but difference is because of methodology. And in 2004-5, it was 5.5%, and it has gone up to, in 2014-15, to 6.5%. Now, I don't have the data with me, but I can tell you one thing. Because financial sector, banking was open almost as an essential service every day. There was no lockdown that affected any of these sectors. Insurance was working, securities market, stock exchanges were trading day in and day out. Mutual funds were open for redemptions and repurchases, as well as fresh purchases. So definitely this share would have only gone up even when the GDP has experienced a contraction during the Corona period, that is 2020-21. When the data will be available, you will have the figures before you, but I am just putting the latest available figures before you to draw this particular conclusion. Now, to just hurry up the things, now I showed you how we have grown. Now, I'm just specifically coming to the capital market. And since the GDP we looked at on a financial year basis, that is 1st April of the year and ending in the 31st March of the subsequent year. So we have the latest data available was of 2020-21. So that's why I am also looking into this particular thing with 31st March data, because then the comparison becomes meaningful. Because as you know, stock exchange data you can have even as of today, because trading has concluded, or even say for instance in the case of FPA investment and all, you can have even what was it as on 3rd of December, which is the last trading day, the Friday. But I have taken only 31st March to ensure comparison with the GDP. And what are you finding it here? There are a few achievements of the Indian securities market or the Indian capital market, which I am summarizing in the table that is before you. First and foremost of all, you are all aware that India is home to the oldest stock exchange in Asia, the BSE Limited. In addition to BSE Limited, we have 6 other stock exchanges. So as of 31st March, we have 7 stock exchanges, number of listed companies, 5,477. There also, I'm sure you are all, at least many of you might be aware, that the total number of listed companies in India is the largest in the world. No other country has this many number of listed companies. And this figure that I am giving, let me give a caveat. It is of BSE only. If we, take into account the companies listed on BSE as well as NSE, there will be some double counting, but the number may hardly go a little bit up only, because there may be a few companies which may be exclusively listed on NSE, but I have not done that consolidation. No agency does it, so readily available data is not available. Now, stock market capitalization, I have put 2 figures there, 2.8 and 3.5. 2.8 trillion US dollar was the size of the Indian stock market as on 31st of March 2021. My apologies. And when I'm talking about a $5 trillion economy, I should be able to give you where are we today. Yes, we have already reached $3.5 trillion as regards the market capitalization of listed companies, companies which are listed on the BSE Limited. Now, some of the other data which I have put are to just, add strength to the argument that I will be making regarding the role of the capital market in a $5 trillion Indian economy. So employment, contribution to gross value added. So all those things. So that's why if I look at it, then investment, which is capital formation. So these are all macroeconomic concepts. And that's why I'm just putting a few numbers which will add substance to that one. So mutual funds, which are the investment vehicles, which actually draw the investments, the savings of the households and put it into corporates, securities. They have, if you look at it, there are 46 mutual funds who together had 1,735 schemes as on 31st March 2021. And portfolio management schemes, there were 361. Of course, mutual funds, if it is for retail, PMS is for people who have larger corpus to be given to a portfolio manager for professional management. Now, foreign portfolio investors, there are more than 10,100 as on 31st March 2021. What is the relevance of it? You all know that India is a capital deficient country. That means that our savings are not sufficient enough to meet all the investment requirements of India. Second is that we are a net importer. So we export less than what we import. So the difference, that is the trade deficit, that also has to be financed. So foreign capital comes in to bridge the gap, which is the trade deficit, as well as the domestic saving gap. Now, one source is, of course, FDI, another source, the foreign direct investment. Another one is the foreign portfolio investment, which earlier used to be called as foreign institutional investment. Now, we have more than 10,100 FPIs registered with SEBI as on 31st March 2021. I will come to the details of investments in my subsequent slides. Now, infrastructure investment trust and real estate investment trust. There were 15 InvITs and 4 REITs as on that particular day. More than 17,000 brokers are registered with SEBI. They may be operating in the equity cash segment, equity derivatives segment, commodity derivatives, currency derivatives, or interest rate derivatives. You name it, all included under this 17,000. 2 depositories. We had 19 custodians which are, taking care of the assets of various categories of investors. Foreign venture capital investors, there were 265 in number, and alternative investment funds, which also includes the venture capital funds, there were 732 of them. And whichever I have been specifically mentioned, I have given the numbers specifically. Others put together, there were more than 3,400 intermediaries registered with SEBI. So capital market, if you look at the institutions, it's a provider of employment, and it's also resulting in value addition. And that is what is captured in the new definition of financial services, which is now being employed by the Central Statistics Office. Now, let's go to the next slide. Now, before we, peep into the future, or rather, it's not, as I told you, it's already 3.5 trillion US dollars. GDP number, I will come to that. But before that, so it's only 3.5 to 5 trillion, which is 1.5 trillion. That's the point that I made. But looking at as of today, where are our securities market compared with the global securities market? Now, if you look at the parameters that are being used, so World Federation of Exchanges, which is basically an association of the major stock exchanges, it compiles annual data, and that facilitates comparison. Now, if you look at that one, the number of trades on National Stock Exchange of India Limited, NSE, number of trades in equity securities, that is the cash segment, that is ranking 4th in the world. This is the annual data, 2020 annual data. Now, in terms of stock index options, NSE was 1st in the world. And that is also because of the fact that the largest traded product in Indian market today is the index options. The bank nifty, the nifty option, all those things. And in case of single stock futures, India was ranking, rather NSE was ranking 4th in the world, 7th in terms of single stock option contracts, 8th in stock index futures, 7th in long-term interest rate derivative contracts, and 1st in currency derivatives contracts. Multi-Commodity Exchange of India Limited ranked 7th in terms of all commodity derivatives traded, 1st position in index derivative contracts, 3rd in precious metal derivatives, and 5th in energy derivative contracts. And I mentioned that, we are the leading, at home, the most popular product is the index option. So because of that, 2 contracts, Bank Nifty and Nifty, ranked 1st and 2nd in the world as the most traded index option contracts. And currency derivatives, I mentioned that, look, we are 1st in currency derivatives, NSE. So currency derivative contracts, especially US dollar INR option, it was ranking 1st in the world. USD INR futures, that was 3rd in the world in terms of number of contracts. And pound sterling to Indian rupee, that was the 7th largely traded contract in the world in 2020. Now, I told you this data is from WFE, and WFE adopts number of contracts as the yardstick because there are several countries, several currencies. So to rather than converting all those turnover into a common currency, say US dollar, they have been adopting that since years ago, that it will be based on number of contracts. So I am just giving you this perspective also, that it is not in terms of dollar value of the trade, it is in terms of the number of contracts traded. So why is it that, I am emphasizing this point is because the investors who trade day in, day out, they are actually, helping, like many a drop make an auction, like even the investor who is trading smaller number of shares also from across the breadth and width of the country, they are contributing to the exchanges coming to the top positions in the global ranking. Now, not because, we are having a target of $5 trillion Indian economy, that I will have 5 points today on what will be the role of the capital market. I otherwise also would have just stuck to these 5 points of emphasizing what will be the role of capital market from today, where we are 2 trillion worth of economy, to a 5 trillion worth of economy. What will be the major role? The main focus areas. That's what I am trying to tell you hereafter. Now, I already told about some facets. One thing which has not been covered. So I will first list out all the 5 points. I believe that from today to a $5 trillion economy, we will be seeing more of market-oriented sources of finance for companies than the bank-financed growth that we have been seeing till a few years before. Why I said that it will be a few years before is that you all are aware that already large corporates are required to have access to corporate bond market for financing 25% of their resource requirements. We have been seeing substantial growth in the corporate bond market in terms of resources raised. I will come to the numbers subsequently. So I am just leaving it there. And of course, that is also, from this particular point, that it will be more market oriented rather than bank financed. Second is that all the growth story that I told you, the global ranking that we have, seen just a few seconds before, everything is based on equity. But I feel that now is the time when debt market will be taking off, if not at the pace at which the equity market or the derivative market has gone, but still then the pace of activity is going to be more in the corporate debt market, corporate bond market. So That's what I believe, more of debt and hybrid. And by hybrid, I have earlier in my slide given to you the data with regard to InvITs and REITs. So these are the hybrid instruments that I am referring here. And I began my talk also by saying how, investors are the backbone of the securities market. I believe that we will be seeing greater deployment of the household financial savings into the Indian securities market. The share of the financial sector savings, share of the financial savings of the household. Of course, they put their savings in physical assets also, like real estate, gold. Of course, that doesn't come under the financial savings. By financial savings, it will be like, what goes into bank deposit, what goes into insurance policies, what goes into provident fund, what goes into equity securities, direct investment in equity securities, what goes into mutual funds, all. So as of now, or till a few years before, we have been seeing substantial chunk of that money going towards banking sector. Deposits, of course, deposit guarantee was one factor. Second was, of course, interest rates were all much attractive than what the rates are today. So we have already seen a paradigm shift from that particular pattern to more deployment of savings, financial savings into the securities market. I will give numbers, latest figures to you. So I'm just moving on to the next point. I envisage that from today to a $5 trillion economy, we will be seeing increasing institutional participation. That means that what I am implying is there will be greater role for the institutional investment. Market will become more deep. Institutional investors, they can be, like as of now, like FPIs. There are, several reports that you might have come across that they are the people who move the markets. But last few years have seen that. I'm not saying that, they have been completely been overwhelmed. No, it's a question of the mutual funds, insurance companies, their asset under management, the deployment of their funds into the equity securities has gone up. So there is an underlying story also for, say, for instance, the mutual funds. Earlier, it used to be debt securities or the liquid schemes or the debt schemes of the mutual funds, which used to account for a substantial share of the asset under management. Today, the things have changed. Now, the AUM of the mutual funds is substantially on account of equity AUM. I will come to that number. So that means that they have money which has to be, as per the scheme objectives, deployed in equity securities. And that is also allowing us to have, greater participation in the securities market. And being chartered accountants, predominantly chartered accountants who are in this audience, that the stewardship role that they can play and the stewardship codes that many corporate governance codes have put in place also means that the institutional investors are getting a greater say in the way the corporates are run. And that only has, brought better future or better prospects for all the stakeholders and not just the majority shareholders. And last, but that is the most important of all, the priority of the 21st century is not just economic growth. It is sustainable and inclusive growth. So it's not that we have to be just, aware of the climate concerns or the greenhouse gas emissions. It's also that we have to be, caring, empathetic towards the society. So that's why the growth has to be not only sustainable, but inclusive. And that is why recently we just have been hearing a lot of news about the Glasgow Climate Pact. We also have come across the national commitment of India, which was propounded by our Honorable Prime Minister at Glasgow. So when you look at it from the securities market point of view, the business responsibility and sustainability reporting, which was earlier the ESG, environmental, social, and governance. So now all put together, business responsibility and sustainability reporting. So these are the 5, core areas that will drive and that will also facilitate India's emergence from what it is today to a $5 trillion economic powerhouse. Now, let me take you to these points one by one. As I mentioned to you, the resource that has been raised by corporates from the securities market has been going up. The numbers are, exceptionally good, in spite of the fact that 2020-21 happened to be the year of the COVID, the year of the pandemic, the year of the lockdown. The resources raised by the corporates across all modes, all avenues, equity securities and debt securities, stood at more than 10 lakh crores of rupees, bettering even the 2019-20 figure of 9.96 lakh crores of rupees. Now, I will just give one more point, one more perspective to say that, look, it will be more of securities market or market-oriented source of finance than bank finance for the companies. And that particular perspective is that the incremental bank credit to the commercial sector during 2020-21 was less than the funds that have been raised by the corporates from the corporate bond market in 2020-21. That is the 7,82,428 crores of rupees. So we already are seeing a scenario where the corporate bond market is having a larger role than the incremental bank credit. I'm not saying the total outstanding bank credit, incremental bank credit that has been extended to corporates during the year 2020-21. Now, this is what I just have before you for the 2 points that, look, it will be more of market-oriented sources of financing, and it will be more debt rather than equity. Now, let me tell you, we have the national asset monetization pipeline. We have also the national infrastructure investment pipelines. In both these instances, it will result in the growth of the corporate bond market and the hybrid market. National infrastructure investment pipeline will facilitate growth of the corporate bond market, whereas in the case of national asset monetization, like you have already read that, look, as against brownfield projects, money will be borrowed or money will be taken and invested in the greenfield projects, that is the infrastructure investment trust. So those type of projects are going to, again, I can say, give a big boost to the growth of the securities market or the capital market. So these are some additional perspectives that I would like to share with you. Now, we have been talking about, growth, but I showed you also about what was the share of, what is the size of the Indian stock market as on last Friday. But is it that, because as regards financial services subsector as well as the banking and insurance sector, we have seen the growth has been exceptionally better than the overall GDP growth. Here also, we find that, so in the case of the market capitalization, and look, market capitalization, please don't, suddenly think that it's all because, the asset prices go up that market capitalization go up. Yes, that's only one among the ways which market capitalization can go up. Another one way that market capitalization can go up is where fresh resources are mobilized, more securities are getting listed, more companies are getting listed. So new listings and existing listed companies raising fresh resources from the securities market by, say, rights issue or preferential allotment. So that way also, what happens is that there is capital investment, capital formation that is happening. So that is what is that you have to be taking note of from the slide. And how has, relatively speaking, looking at what has been the overall GDP growth, what has been the growth of the stock market capitalization of India. I am putting before you the data from 1989-90 to 2021. And that 2021 is as of 31st March 2021. What you are seeing from that orange line, that is the stock market capitalization ratio. That is stock market capitalization divided by GDP. And the blue bars are the stock market capitalization actual figures in rupees crores. So, you know, yes, it is growing. From the blue bar, you know that it is growing and it's growing very well. But how is it when compared to the GDP? That's where the finding that I have to share with you is that from 13% of GDP in 1989-90, it's going to 104.9% in 2007-8. That is the year just before the global financial crisis. And in spite of a big dip during the Corona year, of course, March was the worst year for all the stock markets across the globe. And India was no exception. This one particular figure that you are seeing is 55.8% of the GDP. India's stock market capitalization had crashed from 104.9% of GDP in 2007-8 to 55.8% of the GDP in 2019-20. But hold on, we have gone back, bounced back to 103.5% of GDP during 2020-21. So this is what I have before you to say that it will be more of securities market or market-oriented finance for the corporates, and it will be seeing greater role for the debt market as well as the hybrid instruments than it has been in the past. Now, I told you that, look, I mean, it will be greater retail participation in the stock market. There are several factors that can be cited for the greater retail participation. Of course, everything that all of us will first cite that, okay, we were all, lockdown. We were all under lockdown. Nothing was available. You could not even order something online. So everybody had lot of their income saved and without being spent on discretionary items. So the excess savings that have accumulated, I'm not saying, this is the only one factor. One of the factor is that we have seen that savings that have been accumulated during the lockdown period. And that is why, this is one of the factors across the globe. So even in the US also, they were getting paychecks. So that also used to be put into the stock market. And that also was one of the factors that has explained the rally there. I'm telling you, please note, it's only one of the factors. So that excess savings got deployed into the securities, the units of the mutual funds and equity securities directly. I have a few numbers to, draw how large that particular surge was. Yeah. So April 2020 to June 2020, that is the first quarter of the financial year 2020-21. The savings as a percentage of GDP, the financial savings of the household as a percentage of GDP had surged to 21%. And you know what it was during the previous year, corresponding period of previous year, it was just 4% during the first quarter of 2019-20. So from 4%, a five-fold increase in the financial sector savings. I took time to locate this figure and tell you because this is one of the factors, and this will explain, some of the statistics that I am putting before you. Second, as I told you, I mean, this is only one of the factors. There are many other factors also that is driving the retail participation in larger numbers. First, I mentioned this particular point. Second, of course, comparable financial saving instruments, bank deposits, all those things. Of course, gold is an exception and other securities also are there. But what I'm telling is what used to be the first preference for these households, the attractiveness has come down. And that's why, so what I'm saying is the attractiveness of the securities market instruments, equity shares, as well as units of mutual funds, which will also offer portfolio diversification as well as professional management. It has gone up during the period, not just 1 year, even over the last 4-5 years, the securities have become more attractive. And that's why they have been looking at this with a, very positive attitude. So what I'm saying is attractiveness of the instruments in terms of returns have gone up. Another feature that I would like to tell you is that mobile trading, internet trading, then UPI along with ASBA, application supported by blocked amount. So the technology, the role of technology, it has played a great role in increasing the retail participation in the securities market. Another one point that I can tell with regard to technology is the offline eKYC that is being allowed now. You don't need to go to any intermediary, no mutual fund distributor, no broker, no KRA, KYC registration agency. You don't need to go. You can sit at home. You can do Aadhaar-based eKYC offline and you can start investing. So there are many such things that has played a role. And let me tell you, it's not that, I am not patting my own back or, complimenting SEBI. There have been a lot of investor awareness activities. Even before Corona and even during Corona, it just moved from offline mode to online mode. So SEBI registered resource persons, securities market trainers, then stock exchanges, depositories, brokers, everybody had been under mutual funds. Everybody had been undertaking a lot of investor awareness and education activities. So people just got to know more. And that is what I can say is that everything started building up and then we started, like a tsunami, it all just became. Now, why I'm saying tsunami is because now just look at, just one number that I can tell you. Every month on an average this year, that is 2021-22, we are seeing almost an addition of 50 lakh new investors. Now, why I'm saying is, see, it's the sum total of the demat account as well as the mutual fund folios. There could be duplication. It may be my own account with I'm opening a new account. Let's very simply, I am opening 5 folios with 5 different mutual funds. So I'll be counted 5 times. But still then, the number is something that is very different from the trend that we have been seeing in the past. 7.38 crore demat accounts with the depositories. That is a total of all the demat accounts with both NSDL and CDSL. But the thing is, 26.7 lakh new demat accounts are being opened every month since April 2021. I am quoting these figures and not the previous figures because we are seeing the numbers going up every month. So I have taken the average for April to October. And of course, as I told you, market crashed like anything in March 2020, but it quickly bounced back. So you are finding a lot of attractiveness in investing in the market also, and nobody wanted to be left out. Plus, IPOs that were coming into the market, we have never seen this type of oversubscription. Even the retail investor quota in retail individual investor quota, that is up to 2 lakh rupees of application, that also is getting oversubscribed. So you are seeing that, one perspective is that the IPOs are getting oversubscribed and they are getting listed with listing day gains also. And another one thing also is that the fund turnaround time also has come down drastically. You apply for IPO and you can even use ASBA, which means that you are not parting with your money, money remains in your account. And if you are not successful, the lien is removed. If you are successful, only then the money will be taken from your account. And 6th day from the close of listing, the issue is getting listed. So you see the period is 6 days. And suppose, I'm just, I'm very cautious when I'm saying this one. Suppose it gives 100% return. So what is the annual rate of return? It's for you to compute. So then 11.44 crore investor folios with the domestic mutual funds. So that translates to, from April to October, on an average, we are seeing 23.62 lakh new investor folios are being opened every month. And when I say the role of the households, the retail individual investors, out of the 11.44 crore investor folios, 4.64 crore investor folios were SIP accounts. And SIP, of course, is almost 95, 99. I'm not giving any backing, but I'm just making a guesswork here, because it is all retail who will go for SIP. It will not be a high net worth individual who will go for a SIP. Mostly it will be retail, small amounts, 500, 100, 1,000, 5,000. So they are numbering 4.64 crores and they account for 14.8% of the total AUM of the mutual funds as on 31st of October 2021. And I told you long ago, it was basically debt schemes or the non-equity schemes, liquid schemes, debt schemes, all those things were gilt schemes. They were all accounting for a substantial portion of the AUM of the mutual funds. Today, the things are very different. 55% of the AUM of the domestic mutual funds are held by HNIs and individual investors, and they demand investment into equity securities. They are subscribing to the equity schemes rather than they may be subscribing to the hybrid schemes, but they're going into the debt schemes the probability will be very less. So it will be mostly a question of, and again, it also substantiates my argument that, look, a larger portion of the financial saving of the household is coming to the securities market. And I foresee this particular trend to, gather pace from today onwards, or from whatever was a few years before. Now, I mentioned about foreign portfolio investors. I told you, look, we are a capital deficient country. So how are so what is the major take home that I can tell you as regards FPI investment is concerned? India, as you know, because of the efforts or because of the approach of both the RBI as well as SEBI, it was calibrated opening up of the capital account only. It was we have full current account convertibility, but we are not fully convertible in the capital account even today. But that has helped us tide over any of the external sector crisis that we have come across. Number one. Number two, we have never seen the type of external sector volatility that any other emerging market country has gone through. It stands out as a unique case. And I just suddenly dive from that macro perspective to the securities market. If you see this particular chart, you can see that I am giving the data from 1998-99. Of course, they have been here from 1995. The first wave of liberalization, the new economic policy 1991, in the aftermath of that one, SEBI has been set up. FPIs were allowed to invest in India. And I'm giving this data because this is the data where we get it in US dollar million. If I have gone for, rupee crore, if you are interested, you can look at the data in the NSDL or CDSL website, where you will get the previous year data for 3-4 year data for in rupee crore only. It's not there in US dollar million. What I wanted to tell you from this particular chart, to add to that particular thing that look, we have never seen what you call as capital flight, or why it is called as hot money in other markets. It is not like that in the case of India. It is as stable as, I'm not saying it is FTA, because International Monetary Fund has separate definitions. So this will not, even in spite of this quality, it will not, qualify as FTA. But what I'm saying is this is a totally different picture, in spite of the fact that the same investors are registered across jurisdictions. They have the same investment strategies, objectives, but in India, we are finding a totally different story. And what I am trying to summarize to you from this chart is that except 2008-9, 2015-16, 2018-19, and 2019-20, all the other years, we have been net inflows into the Indian securities market. And only in these 4 years, you are seeing a outflow. And hold on, the outflows have been very small. 8-9, you are seeing $9.8 billion US dollars. 15-16, it was only $2.5 billion US dollars. 2018-19, it was $5.5 billion US dollars. And 2019-20, it was only $3 billion US dollar of outflow. Contrast that with this year and this year. In 2020-21, the net inflows have been 36 billion US dollars. So this is what actually, when you are getting in large amount. But when they are withdrawing, see, as I mentioned to you earlier, that was the purpose by which I put that particular figure. 10,100 FPIs are registered with SEBI. Their investment style is different. Few of them may turn net sellers, but there may be many contrarians among them who will turn, but when somebody turns net sellers, the other people may turn net buyers. That is why the net effect of it is that we have been seeing moderate outflows only, and it has never resulted in any currency crisis or any other sort of external vulnerability. Now, I told you that we are seeing also a substantial growth in the mutual funds. Here also, please let me tell you, readily available data of the historical asset under management I have sourced from AMFI, but that starts from the US 64 scheme, the UTI, the beginning of the UTI. Then, of course, we allowed private sector mutual funds. So it started from 25 crores of rupees, and we have, so that's why I have the two, I am giving you the full data, but I'm giving it in bits and pieces. Let me apologize for that. So this is having up to March 2015. Now, all the things that we have spoken about, the retail coming in large numbers, the stock market performing much better, the success story as regards the SIPs are concerned, all those things, if you look at it, you are seeing that the asset under management from a 10-year, that is from 2021, if you go back up to 2011, it has almost, it has grown more than 5 times. In 10 years, it has grown like this. And as on 31st of October 2021, the asset under management of the mutual funds, it is more than 37 lakh crores of rupees. So the other point, just before I conclude, is I mentioned to you about the sustainable and inclusive growth. I will take 5 minutes for that. What I wanted to tell you is, when we are talking about greenhouse gas emissions reduction or transitioning from whatever it is today to a net zero emissions world, what does it mean? It means that we have to take into account the risk as well as the opportunities that are part of the securities that will finance the transition. And there are already many studies which have pointed out the amount of finance, climate finance or sustainability finance, that is required for this particular transition. I will give the IMF figure. IMF has found that in the next 2 decades, that is from 2020 up to 2040, for transitioning from what we are today to a net zero emissions world, it will require $12 trillion to $20 trillion. Now, as I told you, this amount is for the 20-year period, 2 decades. So on an average of the global GDP, so GDP is an annual measure, this will translate to devoting 0.6% to 1% of the annual global GDP towards sustainability finance. Now, it's not that, look, I mean, the amount involved is very large. It's also because 70% of that finance has to come from private sector. Only 30% will come from the public sector or the multilateral organizations put together. Now, 70% has to come from the private sector. Emerging and developing market economies, including India, their investment requirement has to go up to $1 trillion. Now, that is what makes the field full of opportunities as well as, attractive as well as challenging. Financial requirements are there, but you need to ensure that those are for financing the transition, technology. So it's not just finance, technology transfer has to be there. So from the developed country partners to developing country partners. So this has to be there. So what I'm telling you is, so what is the role of securities market regulator or the capital market? So what we have been seeing is where, the Institute of Chartered Accountants of India or its members also will have an interest, is where it is disclosure-based norms that are being put in place, and the activity in this particular field is being led by the International Organization of Securities Commissions, IOSCO, as regards the securities market regulators are concerned, and IOSCO has identified the IFRS foundation for this particular task of putting in place sustainability disclosures for the issuers or the companies, the investment funds, or in our case, it is the mutual funds, and ESG data and rating service providers. In the sidelines of the COP26 summit in Glasgow, the IFRS Foundation has already announced the setting up of the International Sustainability Standards Board. So the IFRS will have international accounting standards as well as the sustainability disclosure standards also. And the board of trustees of the IFRS Foundation will be overseen by a board comprising of securities market regulators, which will be looking into, which will be bestowed with monitoring the disclosures of the companies in their respective jurisdictions. So this is where, as I mentioned to you, the role of the securities market regulator, and I mean, let me tell you at this particular point of time, as regards banking sector, many of you might have come across two very important news items or developments. One is that there is a network for greening of financial sector, NGFS, which is an association of a get together of central banks. They have been, sharing experiences with the member countries, and from India, of course, RBI also has recently joined. Second part of it is that in the what you call, people might have already been reading that stress tests that are being conducted by the central banks for the supervised banks or the financial institutions. Now, they will also take into account the climate-related risk as regards the stress test. So financial stability concerns are also will be taken into account. So this is what actually I consider that there is a, very paradigm shift that will happen. We already have, at home to mention, like Indian Railways, the annual number of passengers of Indian Railways are larger than the total world population. It has given a commitment of net zero by 2030. We are seeing Swachh Bharat Abhiyan, Namami Gange project, or LED bulb. Then we have the International Solar Alliance. So all these things, there are requirements of finance, and that will mean that the disclosure norms are laid down. And also, it will also mean that those disclosure norms will not allow the corporates, the compliant entity, to do greenwashing. And that is where, the last point that I will mention before you is how SEBI has come out with the Business Responsibility and Sustainability Report in May 2021. And what BRSR envisages is where mandatory requirements are there and leadership for voluntary disclosures are also there. It covers, I would like to leave it to you that if you would please go to that particular circular and read it if you are interested in this particular topic. And it covers the entire gamut. It fixes the responsibility of the management. And it is, like radically different from the business responsibility reports that were earlier in place. And it has been made voluntary for top 1,000 listed companies for this particular financial year 2021-22 and mandatory from 2022-23. Thank you very much.
Thank you, sir. So since we are already overboard with the time, I'll just take one quick question received from the participants. The question I would read is, during the pandemic, the capital markets contributed a lot and retail investors gained confidence in the market. So what are your suggestions for these investors for the coming times?
Thank you very much. This is one point, I am very thankful that somebody has raised this question. I would like you to, of course, I'm myself complimenting the person who raised this question. Let me tell you, capital market investment or securities market investment, this has to have, I will say, 4 P's. Now, before I come to that one, let me tell you, everybody knows there is business cycle. There is always a boom and there is a boost. Be it an economy, any economy, you will find this one. So that is why I am telling you, you have to follow the 4 P's. And what are those 4 P's? One is preparation. Why I am saying preparation, I told you already about, SEBI and market participants and market intermediaries undertaking lot of investor awareness activities. In addition to that one, if you are forming part of it, you are taking part in that one, well and good. Otherwise also, there are a lot of financial publications. Why? I mean, there is a lot of information available in the net for free. So you should, my first P is preparation. You should be preparing yourself for your investment. You will have, lot of advisors your mutual fund distributor will be there, investment advisor will be there, research analyst will be there. But first and foremost, guys, you people should prepare. When somebody gives you an advice, you should be in a position to assess that advice. Yes, what he's saying is right, or what he's saying is wrong, or I am having some doubts on that one. I should ask a question. If you have to do that, you have to prepare yourself. Second P that I am telling you, and third P I am telling you are connected. And that is, one is perseverance, and the other one is that patience. Patience, I am telling you first, I told you there are business cycles, economic cycles, boom, boost. You cannot wish away that one. And let me tell you, I am telling you my experience. I cannot say that, look, I will be so smart enough to come to the market when the market is at a low, and I will buy at that point of time, and I will be able to exit when the market is at its peak. No, I cannot do that. So you need to have patience. You need to invest with a medium-term to long-term perspective, please. And that is why I'm telling you, perseverance goes with patience. Why? What is perseverance? I mentioned during the presentation that it could be even small amount, systematic investment plan, or it could be, direct investment also. So suppose you have decided that, look, I will be investing, rather than putting all the money in one go, invest it in over a period of time. So perseverance, I mean that you keep investing irrespective of, suppose the market has gone up. No, you keep investing again. Market has gone down. Don't lose your heart. Again, keep investing. So I'm telling you, and it does not mean that, look, you should not invest everything in, whole month of your salary or whatever, you are getting you are disposing of some wealth and you're putting everything. No, you just make out your investment horizon, your investment objectives. So you have the patience for that long-term period, and you also have the perseverance. You keep on investing regularly. As I told you, business cycles are there. Nobody can wish it away. So 3 P's I have told, and the last P, that is where we are there, or SEBI is there, protection. Suppose something goes wrong, there are several mechanisms. Stock exchanges have investor protection fund is there, investor education and protection fund is there, investor protection and education fund is there. So MCA, SEBI is there. So when something is there, please approach the concerned authority. And first, it could be, you have agreements with the broker, or you have agreements with the listed company. First, you approach them. And if it is not getting resolved, you go to the regulator, or SEBI has let me share it with you, a online redressal platform, scores, SEBI complaint redressal platform is there. Investor specific website is there. So the 4th P is also as important as the other 3 P's. Please make use of the protection that is being made available to you. And my suggestion to you, all participants, if you follow these 4 P's, I think you will be a successful investor.
Thank you so much, sir. On behalf of the committee, as well as on behalf of the Institute of Chartered Accountants of India, for sharing your vivid knowledge on the subject. I am, hopeful that all the participants listening to us have gained a lot from your session. So thank you so much once again, sir. Thanks a lot.
It's my pleasure. Thank you very much, and have a good evening to all of you.
Good evening. Thank you.